Thank you for joining us for this Project Grow webinar. Project Grow is a new learning and leadership development program for the Minnesota soybean producers developed by the Minnesota Soybean Research and Promotion Council. The goal of Project Grow is to help producers increase opportunity in their operations by advancing their business and leadership skills. This program is still in its infancy stage, so look for more information in the coming year. You can find out more about Project Grow at mnsoybean.org. Today, I am pleased to welcome Ed Usset from the University of Minnesota for a presentation titled, Building an Effective Pre-Harvest Grain Marketing Plan. With the recent jump in soybean prices, this topic is particularly relevant. Ed Usset serves as a grain marketing economist for the Center for Farm Financial Management at the University of Minnesota, the developers of FinPack software. Working with his colleagues at CFFM and in Extension, Ed developed the award-winning Winning the Game series of workshops. In addition, he manages Commodity Challenge, an online marketing education game that uses real-time cash and futures data. He is the author of Grain Marketing is Simple, It's Just Not Easy. And he's passionate about helping farmers to use effective grain marketing strategies to put more money in their pocket. Please join me in welcoming Ed.
Thank you, Ryan, and hello to everyone out there. As Ryan has noted, and as the PowerPoint in front of you indicates, it's mid-June of 2016, and I'd like to start this presentation by noting that even though it is mid-June of 2016, even though we have looked at a very, a nice rally in soybean and corn prices over the last 6 to 8 weeks, the shelf life on what I'm about to tell you this morning goes much longer than June of 2016. And if you come across this webinar in 1 year or 2 years or 3 years, I like to think the approach I lay out today is just as relevant 3 years from now as it is today. There will be some changes to some numbers. Production costs will change in operations, and you can make those adjustments. But I want to assure you that just because we're talking in mid-June of 2016 does not make this irrelevant in 2 years, and the same approach can be used then. So with that in mind, let's get started with some thoughts on building an effective pre-harvest grain marketing plan. And let me set the table here. We're going to write a marketing plan, and we'll start with a definition of what a marketing plan is. A marketing plan, to me, is a proactive strategy to price your grain. It's going to take into consideration your financial goals, your cash flow needs, your price objectives, et cetera, et cetera. It takes into consideration everything you can imagine. And yet the operative word here is that it's a proactive strategy. It looks ahead. It looks ahead for opportunities to be profitable. It's not a reactive plan. A reactive plan is selling grain because, well, I've got bills to pay. My checking account is a little short. I'd better open up the bin and sell a few truckloads of soybeans to pay the bills. It's not an overactive plan. And here I take a gentle shot at those who would have you re-own the crop you sold 2 months ago with call options, only to sell it a second time a few months later and re-own it a third time. That overactive approach also makes me uncomfortable. I'm trying to get ahead of the game plan here with a proactive approach to marketing. Marketing is very important. We've got friends at Iowa State University who will tell you that over the long run, the average farm is earning something on the order of 20 to 30 cents a bushel on corn and soybean production. That's over the long run, over many years. It varies greatly from year to year, and we just came through a period, 2007 through 2014, where 20 to 30 cents a bushel was a woeful performance. We did much better. But we have our ups and downs, and we're currently in one of those down periods where negative numbers may come into play. Here's the interesting point to me on that 20 to 30 cents a bushel. If, in fact, that's the long-term profitability in corn and soybean production, if I can find a lousy dime in marketing or 20 cents a bushel, I can have a big impact on my bottom line. Small improvements drop a lot to the bottom line. So let me, if you will, start this by redefining what great marketing is. A lot of people think that great marketing is finding the high price in the market, and that is great marketing. But that's a difficult game to play. It's difficult to play it well. It's difficult to play that game consistently. Let me give you a different definition of great marketing. Great marketing to me is finding an extra 10 to 20 cents per bushel with a solid marketing plan that avoids mistakes. Well, why do I need this marketing plan? And our current situation with a $3 rally in new crop soybean prices since early April, and it's mid-June. In 10 weeks, we've gone from $8.50 to over $11.50 and close to $11 today on the November 16 contract. That's a big move. We need a marketing plan because fear and greed are very powerful emotions. They affect our ability to make a decision. Our only effective weapon against our own worst enemy, ourselves, our own emotions, our own greed, is a solid plan. I cut my teeth in the grain industry as a buyer and a grain trader. And there was an old saw in the business. It said, you plan your trades, and then you trade that plan. So today, let's talk about how we plan those trades. And then the onus is on you to trade that plan. Well, here is a pre-harvest marketing plan for corn on my make-believe farm. It's got a very simple price objective. It says I'm going to buy crop insurance to protect my production risk and price 75% of my anticipated corn crop by early June. I wrote this plan 6 months ago. This plan, as written, is essentially the same plan I wrote the first time I did it nearly over 15 years ago, year 2000, 2001. The price objectives have changed, and we are going to talk about those pricing targets. You look at this plan, it starts at my desire to price 15,000 bushels at a price of $4.10 cash or $4.60 futures. Now, right here, we should bring up the topic of basis. My mythical farm exists in southwestern Minnesota. And in southwestern Minnesota, a basis of 50 under at harvest is kind of the norm, if there is such a thing, sort of an average expectation for southwestern Minnesota. Those of you listening, you might be from southeastern Minnesota, in which case you should adjust that basis maybe closer to 35 under or 30 under. Basis changes with time. Relatively slowly, but if you're listening to this webinar and it's year 2020, adapt accordingly. I just want you to understand that my basis expectations are buried in this plan. Back to the price targets. I start at 460 December futures, the new crop contract, and work my way up to 610 a bushel. We need to talk about them. I also want to talk about decision dates. Beyond my first price step, every other pricing step has with it a date, not only a price target, but a date. I want to talk about them. And finally, we get to the last part of the plan, and what I consider the least important part, or one of the least important parts, is the pricing tools. They're important, but that's a tactical decision, and we'll get there. Well, let's start with the pricing targets of this plan. Where did I come up with this 460 December futures working my way up to 610 December futures, and of course with a cash price 50 cents lower. I also want you to note down below in the, if you will, the footnotes of the plan, I make a statement, the second statement in green: ignore decision dates and make no sale if prices are lower than 410 local cash price or 460 December futures. That's my minimum price objective, and we need to start there on this plan. That's a very, very important part of this marketing plan, and it's a very important number. We need to discuss where that came from. So step one in this approach to marketing, be it 2016, 2018, 2021, I want you to think about what's your minimum price threshold. And I consider this single decision, the most important choice in developing a pre-harvest marketing plan. Where did that 460 December corn come from? I'm basing that on cost of production in southwestern Minnesota, in southern Minnesota. And I want to note here, I think you should focus on local competitive costs in your area and not your specific costs. Commodity markets are cruel markets. The low-cost producer wins. Occasionally, I will run into a producer who will tell me, you know, you say that the cost of producing corn in Minnesota is, for example, this year, $4.10 a bushel is, I'm going to argue, is going to be the average cost of production. And someone will say to me, but my costs are $1 higher. And to that person, my comment is, you're not competitive. Marketing's not going to get you out of that hole. You've got to work on your production costs to get competitive in your area. So it's a tough message, but that's the cruel world of commodities. And I get back to my point, focus on local competitive costs and not your cost. Well, here's some data I have for the last 3 years on cost of production in southern Minnesota. This information comes from a database called FinBin that we operate at the Center for Farm Financial Management. FinBin is made up of hundreds, if not 1,000, farms that work through the farm business management programs throughout Minnesota. A great program, and if you haven't explored it, I encourage you to do so. The numbers I'm showing you here are not theoretical, they're real. So, for example, in 2014, the actual average cost of production throughout the southern tier of Minnesota on cash rented acres for corn was $4.55. Now, this was, as I note on the bottom, the break-even price to cover all costs, net of government payments, and including a modest return to labor and management. That number last year, 2015, was $3.78. Some of you might be surprised to see such a large drop in production costs, but a big factor in production costs is yield. And in 2015, Minnesota farmers set a state record for corn yields, and that had a big impact on dropping those production costs down. For 2016, I'm estimating about $4.10 a bushel. And we can't, I don't think it's prudent to assume record yields every year. And I'm going with the $4.10, and guess what my minimum price objective was in my plan? $4.10 a bushel. This is an interesting chart all unto itself. FinBin data for cost of production in southern Minnesota for corn since 2005. Note, in 2005, Minnesota producers could produce a bushel of corn for less than $2 a bushel, and we've doubled that plus in recent years. A story unto itself, but beyond the scope of where we need to go today. Soybeans, a similar approach using the FinBin database and hundreds of real farms in Minnesota. Actual cost of production, nearly $11 a bushel in 2014. Again, record soybean yields in Minnesota, 20% higher than the previous 2 years, has dropped production costs sharply to $8.32 last year. Difficult to assume record yields every year. So I've put in an estimate of $9.80 a bushel for production costs in the current year. Again, an interesting chart on soybean production costs in Minnesota. A story unto itself, but the key here is I'm using that current estimate of $9.80 a bushel as my minimum price in 2016. 2 years from now, 3 years from now, adjust accordingly to what the costs are. Spring wheat, I know soybean, there are members of Minnesota soybean way up in the valley, and there's a lot of spring wheat grown up there in conjunction with the soybeans, so we shouldn't forget wheat. And I'm estimating 2016 production costs at about $5.70 a bushel. A similar chart on wheat and many of the same dynamics going on in the corn and soybean markets have been going on with wheat. The Wetabe Database, you can find it yourself. It's a wealth of information and an incredible resource for all producers, highly underutilized in my humble opinion. But there it is. You can find it yourself. It doesn't cost you a thing. www.finbin.umn.edu. It's a great tool for getting an idea of production costs in your area. It's a great tool for benchmarking your own farm. I recommend you explore it. Well, I've explained that minimum price target and how important that is. And that's where that $4.60 December corn came from. $4.10 cash price, 50-cent basis. There we are at $4.60. Now I worked my way up to $6.10. And where'd that number come from? Well, I'm going to explain how I came up with that number. But even as I explain it, and as important as the minimum price was, I just want you to understand that that $6.10, that maximum number, it's the least important choice in developing a pre-harvest marketing plan. It's really not important. The only thing I want you to think about there is I want you to be realistic in choosing that maximum price. An illustration of realistic. Over 10 years ago, I had lunch with some producers. I was doing a marketing program up in the Red River Valley, and a producer told me the price of soybeans at the time, I think, were about $9 a bushel. A producer told me that he was waiting for $20 a bushel for his soybeans. Now, that just struck me as an unrealistic expectation. Now, am I saying we'll never see $20 soybeans? I like to think that someday, somehow we will. But that at that moment, it struck me as unrealistic. So if you've got corn and you're waiting for $10 a bushel, I'm going to tell you that's not where we are right now. Hopefully, I'm young enough to see $10 corn someday, but that's not a realistic maximum target. How do we get to realistic? Well, this is how I did it. I took a look at the history from 1990 forward. This is December corn futures, and I picked out the 3 best years I could find. The best years in terms of the percentage price rise from the start of the year to the highest price of the expiration year. And you've got 3 fairly recent years, 2008, 2012, 2011, anywhere from 40 to 64% higher. These are extraordinary years. These are not normal years. These are the best of the best, indicating something like 50% higher. Okay, 50% higher. $4 corn, 50% higher is $6 corn. So I took 460 December futures and fiddled a bit with the numbers and said, you know what, 610 December futures looks high, doesn't look easy to attain today, but it's realistic. That type of move has happened before. So our process here on price targets, we set a minimum price based on local production costs. We establish a maximum price that's realistic, and I've just given you a sense of what realistic is. And it didn't get me to $10 corn. It did get me to $6 corn. Now we have that minimum and maximum price, and we simply slide in some price objectives in between along the way. Okay, you understand the price targets, the importance of the minimum price, how to establish a maximum price. You got that. Now let's look at the second key component of this pre-harvest marketing plan, and that's the decision dates. Once I get past the first pricing objective, which is my minimum, 410 cash or 460 futures, once I get past that, every other step in my plan has not only a price objective, but a decision date. We need to talk about them. We need to talk about what they are and how they work in the plan. Now, if I reach a decision date before a price target is reached, I price the grain. Decision dates are a very, very important part of this marketing plan because this is what makes it a real plan for action. Crop insurance and or options allow us to price with confidence. And by the way, I've got a little asterisk here where I say if I reach a decision date before the price target reach, I'll price the grain. The asterisk says, as long as my price is above the minimum. And once again, we understand the importance of that minimum price in there. So in other words, let's look at this second step in the plan. Price 10,000 bushels at 490 futures or by March 23rd. Well, what if we got to 460 futures by March 23rd? And in fact, on March 23rd of this year, we're trading at 480 December corn. We have not reached my price objective, but we are above my minimum. I'm going to take that action. And now you can see, you can start to understand why the maximum price objective is less important. As long as I'm above that minimum and I reach a decision date, I keep pressing forward, getting some pricing done. Now, we have to point out again here that all of these decision dates have been clustered in the mid-March to mid-June period, and we have to ask a simple question: why? What's special about those days or that time of the year? Well, let's talk about that. This is a table, a history, if you will, of the Chicago Board of Trade December corn futures from year 2000 through 2015. We're showing 16 years here. And what I've done, and by the way, I've got this data going back to 1950, but if I put all those years up, the numbers get too small. What I've done is I'm taking a snapshot of the December contract twice a year. The first snapshot is in the second column there on May 1. That's planting time. The third column is October 1. That's harvest time. So May 1 to October 1, a 5-month change each year on the December corn contract. Now, if life is a coin flip, you would expect over a 16-year period that half the years would go up and half the years would go down. We shrug our shoulders and say, who can guess? But in fact, that's not what we see. since year 2000, 12 of the 14 years, the December contract has traded lower from May 1 to October 1, from planting to harvest time. And in fact, the average decline, look at the number on the bottom right here, the average decline over the last 16 years has been 31 cents a bushel. I started this little session wondering if we could find a dime in marketing, and I think we just found 30 cents. Now, this is a strong seasonal tendency. It is not a certainty, it's a tendency. And it does make us want to sit up and pay attention in the spring of the year. Here it is graphically. This is a 16-year average of the Chicago December corn futures price. It's an index of that price. We set January 1 to 100, and you note that the springtime, March, April, May, June, on average, 2-3% or better higher than that Jan 1 average, and 6, 7, 8% higher than the prices that come by harvest. I want to get something done in that time frame, in that March to June time frame, when historically that's been a good time to get something done. Soybeans, we take a similar approach. On the November soybean contract, we compare it May 1 to October 1, much less strong tendency, that is 9 of 16 years decline. That's hardly any better than a coin flip. However, I think soybeans show the need for a minimum price. And we're going to knock a few years out of this transition. We're going to take out some years, 2001, 2002, and last year, and frankly, this year, as it was on May 1. And we're going to note that if you take out those 3 years, you say, why did I take them out? Because the opportunity in the spring was clearly below production costs. So let's not get too aggressive when the opportunity isn't there. You take those 3 years out, 8 of the remaining 13 years went lower, almost 2 out of 3, and the average decline was 40 cents a bushel. Again, a good tendency, not a certainty. And you can see it graphically. This is an index of Chicago November soybean futures over the last 16 years, and you can see that there tends to be better opportunities in the spring and early summer. Spring wheat, we shouldn't forget that. Same format. We're looking at May 1 versus August 1. Of course, harvest comes earlier in the world of spring wheat. Again, like soybeans, 9 out of 16 years going lower. It's not much of a seasonal. In fact, the average decline is not a decline. It's a penny rise. However, wheat, more than corn and soybeans, really cry out for having some minimum price standard, because we can take a lot of years out of here where the price opportunity in early May in the spring planting time was simply not up to par relative to production costs. So here I've eliminated 7 different years, and of the remaining 9 years, 2/3 of those went lower, and the average decline was 20 cents a bushel. That minimum price, we keep coming back to it. That selection you make is very important. There it is graphically, focusing on years when May 1 price is higher than production costs, and you see that, I think I want to sit up and pay attention in that March, April, May, June period, as opposed to waiting to harvest to get something done. Okay, final piece of the marketing plan I want to talk about. You understand the price objectives, the price targets, where they came from, why the minimum, why the max. You understand how the decision dates Make it a real plan for action, because if you reach that date and you're above the minimum, you're going to price that grain, even though you might not have met your lofty price target. Finally, let's get to the how part of this equation. How will I price this grain? Am I going to use a forward contract? Am I going to use a hedge to arrive contract? Am I going to buy put options, the right to sell? How am I going to execute this? Well, I'm very vague in my plan. I note that pricing tools are to be determined. And I'm vague because that's a tactical question at this point in the plan. Once you get there, once you reach a price objective or a decision date, and you're ready to do something, now you think tactically, what's the best way to get that done? In my world, pricing tools come in three forms. You've got a fixed price tools. These are the simplest tools. A forward contract, selling futures directly, which producers can do if you have a brokerage account, or using the futures fixed or hedge to arrive contract. I consider these kissing cousins. They are very similar in that they will establish or nearly establish a fixed price for grain at harvest, and no questions asked. Another class of tools are the minimum price tools. This is where we get into options, maybe forward contracting and combining that with the purchase of a call option, the right to buy futures, or simply the purchase of put options, the right to sell. These are ways to establish a minimum price, a floor price, sometimes is what it's called, but leaving yourself upside potential. And finally, and here I want you to think creatively, there's an awful lot of technical trading tools out there, things that follow the trend, and moving averages, oscillators, indexes, and so on. There's a place to use those tools in this plan. I'm going to talk very briefly about each of these tools. Fixed price tools, for example, I know that Minnesota producers over the last few weeks have had ample opportunity to establish a new crop soybean price with a simple forward contract anywhere from $10.50 a bushel up to maybe 11 to 11.25 a bushel over the last 3 weeks. The good news about those forward contracts is if you did it, you know your final price, and that is a nice thing. The downside is that if, in fact, you locked in, let's say, $10.70 for new crop soybeans, if the heat continues and if a dry spell comes in and August is a difficult month, your neighbor might be selling $12 soybeans at harvest, and you're stuck at $10.70. You've got no upside potential. Well, to get past that upside, that lack of upside potential takes you into the minimum price tools, the options. They give you that possibility to enjoy an uptrend. The problem with them, the trouble with options, they cost a lot of money. At the money puts and calls in soybeans, for example, today, on $11 new crop soybean futures, they might be running anywhere from 60 to 70 cents to 80 cents a bushel. I started this program telling you that great marketing is finding the dime, or 20 cents or 30 cents a bushel, and here we are entertaining a pricing strategy that costs 60, 70, and 80 cents a bushel. It may pay off, but that's a hefty price. In general, and here's my general philosophy about this tool. I've got my typical marketing plan for corn, soybeans, and wheat will have at least 5 steps to it, 5 pricing steps, if you will, maybe upwards of 7. You could expand that to 10 or 12. But in general, I like to use simple, low-cost tools to price grain early in the plant. And when I say simple, low-cost tools, I'm talking about the fixed price tools, forward contracts, future contracts, pigs to arrives. I prefer them because early in the plan, I'm close to my production cost. And when I'm barely making money or just close to making money, you know, that's not the time I want to spend 40, 50, 80 cents a bushel on options. That's not the time I want to do that. The options and or the technical tools, they open up this marketing approach. They get creative. They create opportunities. They have a cost to them. I save them for the later stages of the plan. Two reasons. One, options, a big part of the cost is, of course, the time value in there. And the earlier you use options, the more you're paying in time value. The other reason I like it is that the later stages of the plan, we're typically getting into maybe planting or even right into the growing season. And in my mind, trends are most likely to endure during the summer months. And technical tools work best when the trends are strong. Pulling out your favorite technical tool in the middle of January often doesn't make sense to me. That's not where bull markets begin in general. And let's save those bullets, let's save those tools for a time period when they're more likely to work. And to me, that's the later stages of the plan. Little update here. My 2016 pre-harvest marketing plan is a little bit different than one I've showed you. 20 cents higher on December futures and minimum price. At the time of this writing, the December 16 contract was trading at 4.30. It reached as high as 4.45, and just yesterday, June 21st, was a bad day, and we're back down around 4.06 a bushel. We haven't reached my minimum, but you know what? I'm not going to let you off that easy. I've emphasized the need for that minimum price and how I won't take action unless we get there. But here's the cruel reality of commodity markets. Sometimes we're out to maximize profits. Sometimes we are trying to minimize losses. And when we're in this low price scenario, or if we find ourselves in a low price scenario where the opportunities are below and sometimes well below minimum price objectives or cost of production, you have to think strategically about making defensive sales that might be below your cost of production. And you ask yourself, for example, I will tell you that I've already made some sales of December 2016 corn at $4.30 a bushel for my mythical farms. And you're thinking to yourself, that's 30 to 50 cents below your minimum. Yes, it is. Yes, it is. Why on earth would you do that? Why would I sell 25% of a crop at a price that I know is maybe 30 cents below my production cost? I'm going to do it because by harvest, my pricing opportunity might be 80 cents below my production cost. And 30 cents less than production cost is better than 80 cents under production cost. It's a defensive sale. I hope to heck I'm wrong. I hope to heck that a few months from now, I can scold myself for being too early and too cheap. But the fact is, it's also a likelihood that a few months from now, I'm wishing I sold a little bit more at that lower level. So my preference in these periods of low prices where prices languish below production costs, my preference is to get something done, maybe 20 to 40% of expected production, even with price levels that are below my costs. And the challenge I'll leave for you, the question I'll leave for you, is what's your preference? Are you going to do nothing as we get close to production costs and just simply hope it gets better? Or do you step up and make a few defensive sales? You're going to have to make that choice for yourself. Soybeans, November soybeans, by the way, it is mid-June of 2016. This plan, as I'm showing you, was written 6 months ago. And of course, we haven't seen $11 November futures. We got as low as $8.50 in early April of 2016. And yet, just in the last few weeks, we've traded as high as $11.80 a bushel. A remarkable rally in the soybean market, driven by a lot of anticipation of hot weather to come and improved export numbers and a few things going on. It's creating a great opportunity to get started on 2016. We've had a pullback. We're currently in the low $11 range, still an opportunity. Disabuse yourself of the notion that you're going to sell the top. I don't sell tops. You don't sell tops. Oh, I guess if we're lucky, sometime in our lifetime, we stumble upon one once in a while. Shoot for a good average price, and I still consider $11 in the November contract as of June of 2016 to be a good opportunity for a good average price. Spring wheat, we're trading around, at the time of this writing, $5.50 a bushel of the writing of the PowerPoint, but I think we're closer to $5.35. I haven't done anything yet in spring wheat. I'd like to get another 30, 40 cents higher. We might not get there, but I'm thinking about that commitment to get something done, even if the price is below production cost. I have set out here for you, listening, copies, blank templates, if you will, of a pre-harvest marketing plan for corn, something hopefully you can print off and think about, well, what are my bushels? What is my cash price objective, my futures price objective? What are my decision dates? And you can fill out the plan accordingly for corn, soybeans, and spring wheat. This is the plan I've showed you, and the approach I've showed you is the same one I've used for 15 years, and I like to believe that 5 years from now, if I'm lucky enough to re-record this, I will have a very similar approach. But it's not a perfect approach. This is not the perfect plan. The perfect plan does not exist. But I'll take my imperfect plan over no plan at all, because when I write this plan, I'm laying out a benchmark for my goals in the year ahead. And once I have my goals laid out, if the world changes, and we live in a hell of a world, things change. If the world changes dramatically and quickly, well, I've got an idea of what I was trying to accomplish, and I've got something to look at and adapt to the changing environment. If I don't have a plan, I guess I can only conclude that I really don't know what I was trying to accomplish before. And if the world changes, how do you adapt to what you didn't know what you were doing before? I'll take my imperfect plan over no plan at all any day of the week. Well, a quick review here. We need to set our pricing targets. The minimum price objective is very important. The maximum price objective, less important. Pricing grain below costs, I've put out the challenge there. Sometimes we need to do that. What's your preference? I'd like to get something done, even when we're below cost. You need to set decision dates, and seasonal trends point to that March to June pricing period. And choosing your pricing tools, I prefer simple, low-cost tools early on in the plan, and thinking about options, getting fancier with technical tools. They offer flexibility. They offer still a disciplined approach to marketing, but I like to be selective in using those tools. So today, I challenge you to write your own plan, establish your own minimum price objectives, and ask yourself, particularly in the case of corn and wheat, as we are today, where we've got opportunities below production costs and yet much better than they were just 6 to 8 weeks ago. Am I willing to price grain below cost? How much am I willing to do? Well, there you have it, my approach to building a pre-harvest marketing plan. I want to thank you for your time and wish you the best of luck in the years ahead. Thank you.
Thank you, Ed. This concludes our webinar today, Building an Effective Pre-Harvest Grain Marketing Plan. On behalf of Project GROW and the Minnesota Soybean Research and Promotion Council, I would like to thank Ed Usset for his time and for the valuable insights he shared with us today. We encourage you to visit the Project GROW section at mnsoybean.org to review this webinar and for other content that will help you become a more successful soybean farmer. We will be having another webinar with Ed on August 17th, 2016, so please look for information on that and watch for other future events like this from Project GROW. Thank you for attending the webinar.
How'd we do, Veronica?